Good morning, ladies and gentlemen, and welcome to the UTILICO Emerging Markets Trust PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. And before we begin, as usual, I would just like to submit the following poll, and if you could give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to Lead Fund Manager Charles Gillings. Charles, good morning, sir.
Jake, good morning, and welcome everybody to our fourth presentation. We've done these every 6 months, and this is our fourth one. Today I'm joined by Jacqueline Brewer, Deputy Portfolio Manager, and Mark Lebel, a Senior Analyst who looks after digital and communications within our portfolio. Some of the presentation today, I think we may touch on areas and style that you would have heard before, but I think it's worth re-emphasizing. But the one message I hope you come away with is a strong conviction, a high conviction from us in the performance of our underlying portfolio. But starting at the top, we remain a fund focused on the emerging markets, and that ranges from Chile, Brazil, through to China, Philippines. So a broad spread, and predominantly in the emerging markets. Top left, asset focused. Most of our investments are asset backed, so it'll be an airport with runways, terminals, or a data center with physical infrastructure. All of them are predominantly operational assets. So I think over 95%, if not higher, are operational. So they have a runway, have a terminal, or already have a data center. And that gives us a lot of confidence about the underlying performance of those assets, because we're not trying to build into the dynamic, if you want, initial investment into land and construction, etc. We're able to look at the performance of the management team. Bottom left, we are benchmark agnostic. I know you've heard us say it before, but it's worth re-emphasizing. We do not come in and look at the index or any other yardstick for our investments. We're looking for the best investments we can put into the portfolio, and those investments that do make it in the portfolio are high conviction. We are bottom up. What does that mean? We do a lot of research. We really understand the assets. We visit them. We challenge the management team. Our approach is a long-term investment horizon, so you won't see us trading in and out of a particular position. We do take ESG into account. It isn't a hard line with us, but we definitely take into account ESG when we're looking at the underlying investments. What is all this translated into? A strong performance. Disappointingly, the last year has just slipped behind the MSCI, but if you look at the 3-year, 5-year, and definitely since inception, we've outperformed the market. And looking forward, I have high conviction that the portfolio continues to perform. Next page, Mark. Unique features. It's worth underlying that we are the only UK-listed fund focused on infrastructure and utility assets. We think those assets benefit from both the, if you want, secular drivers within the emerging markets, so urbanization, growth of middle class, but a strong overlay of 4 megatrends that we have identified, and come on to that detail later. But those megatrends are certainly accelerating the performance of our underlying assets and investments. As I said before, real assets, so offering attractive growth yield, and currently compelling valuations. We're able to look at them over the long term, and they have a predictable cash flow, sustainable, and usually a growing income. And all of that drops to the bottom line and delivers a strong return for us. Experienced management team. I've been here since 2005, and so has Mark. Jax has been here over 10 years. So a lot of capability across the team. What has this led to? It's led to, as I've said, the outperformance of the MSCI index. A feature of our portfolio is we have low beta, and you'd expect that with the nature of the assets. And our active share is high. We are not replicating the index. We're looking for genuine investment opportunities. And as you'd expect, the active share is therefore high. Next page. Just graphically presenting it, you can see our NAV and share price have outperformed the MSCI index, and that's very, very pleasing to see. And we look forward to delivering ongoing compounding returns over the coming decade. Next page. Underlying our portfolio, because of the nature of the investments, as I've said, they're cash flow generative, most of the investments pay a dividend. So over 80% of our portfolio today is paying a dividend, and that enables us to pay a rising dividend to our shareholders. And this graph, I think, just underpins that. We pay our dividends quarterly. In fact, we've just paid one in June. So, a consistent rising quarterly dividend. And this is something we would seek to achieve over the long term. It's not a core driver, but it's more an outcome of the nature of the assets we're invested in. Next page. Jax will take you through a macro update.
Yeah, just quickly, I'll go through the macro update. I mean, as Charles said, we are very much bottom-up investors. We are looking for companies that can offer us strong, sustainable operating cash flows with potential for income growth at attractive valuations. However, we do weave in macroeconomic and political factors into our investment process. If you look over the last year or two, since 2023, we have seen very, very strong growth coming out of the US, which has meant that also there's been higher inflation rates. And this has resulted in interest rates in the US and developed markets being hiked up dramatically over the last year. One anomaly, though, has been China. We expected, I suppose, since COVID, since the opening up of the Chinese market, that we would see the revenge spend that we saw in the developed markets. This never materialized. Consumer confidence has remained weak, and the property sector has seen cracks appearing. And we've seen a very lackluster response from the Chinese government. But if we look back to sort of the beginning of this year, it's been really interesting, actually, when I look back. Beginning of January, well, in January time, we were expecting the US to start cutting rates sort of 6-7 times. We were expecting 6-7 rate cuts in the federal interest rates. This hasn't happened because the US economy and employment remains incredibly strong. So does the FX. And this is kind of hurting emerging markets at the moment. Many countries, many emerging market banks have hiked up rates, but interest rates or inflation rates, have come down. So real interest rates now are high. In Brazil, we're seeing real interest rates of around 6%. Therefore, what does this mean? It means that central banks, though, have been unable to sort of cut rates at the rate at which they want, because they're worried that if they do, their FX rates will be affected and their currencies, therefore, will depreciate. We also have seen over the last year or two increasing geopolitical tensions. We had the Ukraine-Russian war continues. We've now got additional pressures in the Middle East, and tensions with the US and China have also continued. Also in 2024, we've seen over, depending how you cut the data, we have seen over 50% of the world population go to the polls. We've got the US election coming up in November. We've also got the UK one as well. But we've seen India and Mexico and even Indonesia and Taiwan have also had elections earlier this year. The outcome for the Indian election was interesting for us. We expected Modi to win. However, he was forced to now build a coalition government, which actually we think will be beneficial for India because there'll be a check and balance against him. Mexico, though, was a bit of a surprise, with Claudia Sheinbaum actually winning a supermajority. We expected her to have higher checks and balances within the houses. Nevertheless, we're hoping that her bark is worse than its bite. and therefore some of the policies which he has announced so far or looks to implement will actually be diluted down. Nevertheless, if you look across our portfolio, our stocks are very much bottom-up driven, and we've got a number of structural growth drivers and infrastructure global megatrends that will remain in place, and these are the fundamental drivers of our investments, rather than the macro and political factors that I've just described. If we therefore look across the portfolio, why is our portfolio remain so resilient? Well, we believe we've got a number of factors that give us protection in this difficult macro and political environment which we're currently in. Firstly, inflation. A number of UEM investment companies have concession contracts, especially if you look within the utility sectors, that are linked to inflation. So if there's an increase in inflation, then a utility contract will automatically pass through that inflation to the end consumer. Many companies also within the transportation sector have very monopolistic nature or a very strong market position. Therefore, inflationary pressures have been able to pass through to the end consumer once again. And we can see the same within energy prices. Energy generation assets have benefited from the volatility of fuel prices. But again, a lot of the contracts, especially within the transportation sector, are able to pass through fuel price increases as it's already inbuilt into their contracts. Interestingly, some of the transportation companies within UEM have actually been able to pass through energy price increases. And as we've seen fuel prices decrease, they have not matched that decrease, and therefore actually we're seeing margin expansion. I've now been at UTILICO for over 14 years, and one of the key questions everyone always asks is how do emerging markets companies cope with higher interest rates? This really, though, is not very much of a new phenomenon for emerging market companies. Interest rates have been very volatile, especially for companies in Brazil. So therefore, higher interest rates for a lot of our investee companies are not a new thing. But over the years, they have managed to deal with the higher rates of interest. When I first started, it wasn't uncommon to have a company in Brazil with an interest rate or a net debt to EBITDA level of over sort of 8-9 times. This has drastically come down. Management teams realise that they need to control or look after their balance sheets in a better way. So if we look across the portfolio now, the average net debt to EBITDA across the portfolio of UEM's portfolio is around 2.2 times. So it means that companies are very well able to cope with higher interest rate environments. Also, the debt in which they take on board and the currency of the debt they take on board now typically tends to be in local currencies. So therefore it's matched their income streams. And furthermore, as we've already mentioned, geopolitical tensions. Yes, there has been an increase in geopolitical tensions, but this is providing us at UEM with a number of different opportunities in which we can invest in. For example, the fallout from the US-China tensions has meant that manufacturing that may have only been done in China has moved elsewhere. India, Vietnam, Mexico have benefited from these. This sort of nearshoring, friendshoring, onshoring has been one big driver of the UEM portfolio over the last few years. Move on to the next slide, Mark. So one thing that has been very clear, though, and continues to be very clear, is the valuations. Emerging markets continue to be cheap relative to developed markets. If we look at EM valuation at the moment, over the last 10 years, the average PE ratio has been around 12.9 times. At the moment, EM equities are trading around 12.5 times, so we're cheaper than the 10-year average. If you compare this to the S&P 500 cyclically adjusted PE ratio, which at the moment I think is absolutely ludicrously high, then you can see that that's trading at around 30.8 times, higher than the 10-year average of 25.9 times. But what I think is very attractive to investors at the moment is that UEM's portfolio continues to be very well placed. It's attractively valued at 11.1 times PE. And if you layer on top of that the 17.2% discount that we're currently trading at, and our sector-leading performance with a dividend yield of around 3.8%. As Charles mentioned, the low volatility, we have a low beta to the index. This provides investors, I think, with a very compelling entry point at the moment for UEM.
Thank you, Jax. In terms of reinforcing the drivers behind the portfolio, there is clearly the structural drivers that everybody is used to seeing, and it was just helpful, I think, to set out for you a set of visual slides around demographics. You know, if you look at a China or Brazil, there is significant growth opportunity within the demographics before they reach developed market levels. And the other thing I would note is within those demographics, if you unpack them, the number of women in work very often is much lower in the emerging markets, although changing quickly. The demographic drive isn't just about age, it's also about, if you want, employment within the economies. Increased urbanization, this is an ongoing trend. And every time we travel and visit countries like Vietnam, I'm always struck by the sheer urbanization process that is and continues to be underway. And that growth will drive, bottom left, the rise of the middle class. I've always said, as populations urbanize, as the urbanization benefits of, if you want, proximity and efficiency and productivity rise, you'll see a rising middle class. And this is a view shared across, I think, any economist looking at the emerging markets. Behind it, there's strong GDP growth. India, Philippines, these are strong drivers for performance. I would note that GDP growth isn't necessarily correlated to our portfolio. We're looking for assets that can perform in the environment in which they're in. So we don't start out with, we need to be, if you want, exposed to that GDP growth, but it helps the entire economy, helps the drive of the middle class, and therefore is definitely a benefit. Next page, Mark. We've talked about global megatrends, and just to unpack them a little more, but I see these as, if you want, accelerating outcomes. So if you looked at GDP growth, one of the observations I'd make is, if India's GDP growth is 6-7%, their energy growth needs to be 8-9%. Energy needs to run ahead of GDP growth because it's enabling the economy to perform. So you will see across the emerging markets just raw energy growth. But you're also seeing a fundamental transition. Along with the rest of the world, the emerging markets are looking to transition to renewable energies, sustainable energies, and also looking for energy security. I think the Russian invasion of Ukraine has caused one certain outcome, and that's everybody's looked at energy security. And all of this has meant above average investment from Brazil through to China, through to the Philippines in renewable energy projects and transmission connections. And it's a big driver. It should be here for the next 10 years. If I look at digital infrastructure, there is a big shift globally from what I would call the physical economy to the digital economy, be it banking, be it the way we interact socially, be it the sort of drive of AI. One of the hallmarks, I think, of the digital age is the need to move into the cloud, to be able to, if you want, share information and exchange with a global base. And that drive needs to be underpinned by, if you want, the interconnection links within the digital infrastructure, but also data centers and other businesses that are benefiting from that shift to the digital economy. Social infrastructure, as middle classes increase their expectations of life. We're seeing across the world a shift or a demand from large cities around waste management, around urban transportation, around, if you want, travel capacity, and all the social infrastructure is driving opportunities for our portfolio as new investments go in to meet the expectations. Global trade, I know everybody's concerned about, if you want, the level of global trade and where it's headed. I think where I sit is there is a big shift being undertaken, and it's being driven by COVID and the breakdown of supply chains. So you're seeing industrial corporates looking to diversify their supply chains. At the same time, there is a reasonable amount of friction, especially between, as Jax has mentioned, between China and the US, and that friction is causing corporates to relocate their supply chains and to nearshore, and those two drivers are causing significant investments and significant performance within the portfolio. We were in Mexico earlier this year, and I think we were all amazed at the level of integration that is taking place between, if you want, the industrial base in America and the manufacturing hub in Mexico, and the infrastructure needed to support that. So very exciting trends that I think are here for the next 10 years. Yeah, looking at our differentiated portfolio, Jax will take you through it.
Yeah, so as Charles mentioned, we have got a number of underlying drivers that are sort of helping us construct the portfolio. And then if we look at our sort of investment mandate, it's very much utilities, infrastructure companies and related sectors. And this slide really helps sort of explain how differentiated we are from any other sort of emerging market portfolio. And if you look on the right side here, you'll see what the UEM on the left side, you'll see what the UEM portfolio looks like. And on the right-hand side, we've got what the MSCI Emerging Market Index looks like. And we've broken it down to sector split and also geographical split. And what you can clearly see is that if you look at the UEM portfolio on the sector split, the biggest sector in which we're invested in currently is 19.5%. And that's nowhere to be seen within the MSCI Emerging Markets Index. The MSCI Emerging Markets Index constitutes of around 23.3% in ITs. We have no exposure within UEM. Financials, 22.1%. Again, we have no direct exposure in UEM. If you add up all the sort of the utility sectors, stocks that we have, UEM has exposure of around about 40% or just over 40%. And that sort of maps across the MSCI Emerging Markets Index, where utilities make about 2.9%. So that clearly shows you how differentiated we are as a portfolio versus any other EM portfolio out there. And then again, on a geographical basis, if you look, China makes up around 27% of the index, whereas we have much more exposure to Brazil. We're at 23.6%. Again, showing you how we are so benchmark agnostic, and that has given us the active share of over 98%. And I always sort of quote this phrase that we got from an investor once, but I think it's a really great way of summing up what UEM stands for. We are an attractive alternative way to gain exposure to the economic growth of emerging markets, as Charles mentioned, the structural growth drivers, and via resilient, less volatile return profile of infrastructure and utility-related investments. So if we now dive into some of the investments that we are invested in, one of the first one which is playing that sort of digital infrastructure megatrend that Charles has already highlighted, is InPost. InPost is one of Europe's largest e-commerce delivery players. It has a market cap of around $9 billion and it listed on the Euronext in Amsterdam in 2021. InPost started off primarily in Poland, where it currently has around 45% market share of business to consumer deliveries. Effectively, it provides a locker logistics and locker network. If you go to Sainsbury's, or if you are, I don't know, hanging around one of the local convenience stores, you might see one of these lockers there, because InPost has now also diversified into the UK and is also in France, Spain, Italy, and Portugal. And what they are doing is they currently have around over 37,000 automated parcel machines. And these lockers enable sort of businesses to deliver parcels to the consumer directly to a locker where you can go at your own convenience to go and pick it up. So it has huge operational leverage, because one of these lockers means that it's more convenient for an individual to go and pick up a parcel from a locker, because you can go whenever you want. It's also cheaper for a business to deliver deliver a parcel, and it's also much more environmentally friendly. The carbon footprint for InPost to deliver to a locker is about 98% less than it is to deliver door to door. And this more convenience, or this driving convenience, is helping drive the financial performance of InPost. I mean, we've seen parcel volumes have increased by about 60.8% CAGR over the last 5 years. And we've seen this very strong growth in EBITDA growth of 88.9% CAGR, with margins improving as we're seeing utilization rates of these lockers increase. The growth outlook still for InPost looks remaining very strong because there's huge penetration and growth within the e-commerce sector. So as we see a drive in that sort of digital infrastructure, drive in e-commerce, we should see InPost benefit very much off the back of this.
Thank you, Jax. To dive into another investment which we've been increasing recently, Serena Energia. This is a company based in Brazil. It's got 2.7 gigawatt of operating capacity today. And I think if you look at the bottom left slide, you can see the significant growth they've achieved over their life. They IPO'd in 2016. We invested in them shortly afterwards. The performance in terms of share price was good. We exited near the top of the graph on the bottom right. And we have recently gone back in. Why have we gone back in? Their ability to drive their performance and bottom line is exceptional. And with the weakness in their share price, we felt the market was ignoring their delivery and their performance. So this is an undervalued investment in our view that should continue to perform at an operational level, and the valuation metrics will catch up. In terms of the next slide, in terms of just trying to look at their portfolio, they have a portfolio mainly of wind farms in northern Brazil. And the thing I'd note about the wind farms in northern Brazil, they benefit from the trade winds, which are incredibly consistent and very dense in terms of water vapor. And that drives one of the most efficient wind farms globally. So they've got a fantastic position in northern Brazil. They've invested recently into Texas. Texas is a fascinating energy grid system, and they have successfully invested in, built and delivered new capacity there. You can see their EBITDA margins are running around 50%. We would expect that to trend up. You can see that the EBITDA growth in just raw growth is strong. And again, looking forward next 5 years, we would expect that to continue. One risk with renewables is to ensure that they have, a highly contracted revenue. And you can see if you look at their revenue base, they tend to have a run with a high level of contracted offtake agreements, so regulated PPAs, bilateral PPAs. And while there is a degree of uncontracted at the moment, over time we would expect them to contract that up and ensure they can deliver the returns that they have over recent years. So attractively valued, very strong growth, and we're looking forward to further performance.
Yeah, one of the third investments that we're sort of going to describe today, or run through with you, is Santos Brazil. And Santos Brazil is really capitalizing on the shift in global trade. Emerging markets as a percentage of global GDP by 2040 will exceed that of developed markets, which is just showing you how important emerging markets are becoming within sort of global trade. And Santos Brazil is incredibly well placed to capitalize on that growth. Santos is a port and logistics operator. It owns 10 terminals along the coast of Brazil. However, the main terminal it operates is one called Tecos Santos. And it currently handles around 1.7 million TEUs, which is equivalent to around about 16% of Brazilians' TEU volumes. Santos listed in Brazil back in 2006 and has a market cap of around 1.9 billion. But what's interesting about Santos Brazil is actually the Port of Santos as a whole handles around 25% of Brazilian trade. It's around 200 kilometers away from the capital, from São Paulo, and therefore it is able to really capitalize on the engine room of Brazil. But what is also quite niche about Santos Brazil, and this is the main reason of why we're kind of investors at the moment, is that it's not only has a very strong strategic importance, but actually Santos Brazil's port within the Port of Santos and is very well positioned. Currently has around 40% market share, and the other players are DP World and BTP. Both of those ports, they were operating at nearly full capacity. Santos is the only one that has capacity. So therefore, as we're seeing GDP plus growth coming through the port, Santos is able to capitalize upon that. It is also therefore able to be in a very strong pricing position, as shipping lines are basically becoming hostage to Santos as they need Santos's capacity in order to be able to serve their end clients. And we saw that last year, actually. Santos managed to increase the handling price of its TEUs by over 60%, just showing you the pricing power that Santos has had. Also, volumes continue to remain incredibly strong. For the first 5 months this year, we've seen 25% growth for volumes coming through Santos, which is absolutely astonishing. This stock, though, as well, has a huge cash flow, or very strong cash flow generation, which is enabling the port operator to pay out currently around 95%, which means that it's given us a yield of around 6%. And the stock itself is currently trading around 8 times EV/EBITDA, which is, we believe, still very, very attractive.
Thank you, Jack. Social infra. Manila Water is a new investment in the portfolio over the last 12 months. We were investors in Manila Water back in the early days of UEM, so sort of 2005, 10, 12. We understood the asset. We loved the asset. However, the management team, and we sold out and did well. The management team then, in our view, took a number of missteps and didn't have the support that they needed from government. So what's changed? The government and the regulation within the Philippines has strengthened, and that's a positive. But the biggest positive is that there's been a change of strategic shareholder. A new shareholder has come in and taken a majority stake, and they are backed by the Raison family. Now, the Raison family stand behind the management team, and if you want the performance of ICT, ICT is today our second biggest investment. I usually say our biggest, but our second biggest investment, and their performance as a management team has always surprised. And I expect that they can deliver the same here. Manila Water provides water to the eastern zone of Manila. It has a long-term contract, which is what you'd expect with these assets. So 2047, it's serving a large population, listed on the stock exchange with a market cap of $1 billion. Go over the page, Mark. We can already see the benefits, if you want, of incoming shareholders with the EBITDA margin rising back up to levels where it should be. And the share price has moved positively, although we're looking for further gains. They are attractively valued, single-digit PE, and that ought to change as the market gains confidence in the ability of the incoming management team. To give you some feeling, though, because I think sometimes it helps to understand top to bottom on an investment. Last quarter, the first quarter of 2024, Manila Water's revenues were up 20%, and that's driven by, if you want, regulatory pricing that they were able to benefit from. EBITDA was up by 29%, reflecting the leverage nature of these assets, whereby revenues tend to drop to the bottom line. But, you know, EBITDA margins over 70%, 60%, so good, strong margins, and the EPS rose by 50%. So if this company can continue to perform, I've no doubt it will meet our expectations. In the immediate term, their yield is running at just under 6%, and that's attractive. So I hope those 4 investments help you understand our excitement about the drivers and the opportunities that we see within the portfolio. In terms of trying to sum up then, the portfolio itself, top right, cash generative, as I've said, over 95% cash generative operational assets. And I should emphasize over 95% listed. Our investments are listed in stock exchanges across the globe, and their pricing is mark to market day to day. So a proper, if you want, yardstick for valuations. Second point is Jax has emphasized compelling investee company valuations. If we look at the performance over the first quarter, it's been ahead of our expectations, and the market largely has not moved significantly in terms of valuing that performance. We are resilient through economic cycles. While we do pay attention to elections and policy, we're able to look through the longer term cycle. As you saw with Manila Water, they have a concession until 2047, so we can take time to out the value. We are differentiated from the MSCI index, as Jax has more than demonstrated. We have almost no correlation with the MSCI index. It isn't something that comes into our thinking. In terms of performance, over the long term, we've outperformed the index. We have a covered and growing dividend, paid quarterly, high active shares, I've noted, and a specialist investment team. I can't underestimate the value of the collective team, the trips that we do to Latin America, Asia, Europe, and properly understanding assets and the dynamic that they can deliver. So I would leave you with the thought we are, I think, a highly resilient, undervalued investment that you can buy at a discount today, significant discount today, because of the discount to NAV, with a reasonable yield of nearly 4%. So on that note, we'll take questions.
Perfect. That's great. Charles, Jacqueline, Mark, if I may just jump back in there, and thank you very much indeed for your presentation this morning. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the right-hand corner of your screen. But just while the company take a few moments to review those questions that were submitted already, I'd just like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can all be accessed via your investor dashboard. Guys, as you can see, we have received a number of questions throughout your presentation this morning. And thank you to all of those on the call for taking the time to submit their questions. But Charles, perhaps at this point, sir, if I may just hand over to you to chair the Q&A with the team, if I just read out those questions and give your responses where it's appropriate to do so, and I'll pick up from you at the end. Thank you.
Thank you. So far we have 3 questions. So the first is around unlisteds and rationale for unlisteds, and do we feel this is a drag on their overall portfolio value? I think 2 things on the unlisteds. I think as the years have gone by, we've come to understand they do take more effort and time. We've usually used them because we want to benefit from a deeper understanding of an opportunity or a market. So we, for instance, have had an investment in a wind farm onshore China, and that was a joint venture with a number of leading players within the Chinese market. And while it's performed, I think it's true to say that it's given us more difficulties than we would have anticipated at the outset. So I think our view at the moment is it's not a drag today. It's probably marginally a benefit, but unlikely to be repeated because it just takes so much time, energy, and resource. dealing with the second question, Jax, which is how do we look at geographic diversification within the emerging markets?
Yeah, look, as we've discussed already within the presentation, I mean, we're very much bottom-up investors. So the geographical allocation is very much of an outcome of the investment opportunities in which we find. Brazil, obviously, at the moment is a higher exposure, around 23%. And that is very much an outcome of the investment opportunities we're seeing. I mean, I can talk about a number of the investments within that geographical within Brazil that are showing such strong, phenomenal growth despite the macro and political pressures that we're currently witnessing in Brazil. A number of the companies are seeing 20% top line growth, EBITDA growth at the same level. So therefore, we are still comfortable, I suppose, with that exposure to Brazil, despite the noise that we are, or the noise that we are hearing. Saying that, though, I mean, it is 23%. So I think, Giles, I think you'd agree, exposure much more than sort of 23%, we would probably start to look at much more closely. And also we do, like I said, we do weave in macro and political noise into our investment process. For instance, I don't know, Russia is an area which we would never invest in. We have been in the past invested in it, and that taught us why we don't want to be invested in Russia, or when we could be invested in Russia in the past. And so we do very much layer that into our investment process. However, it isn't the driver. So the geographical outcome or the diversification is very much an outcome of the bottom line, the bottom-up investment process.
Thank you, Jax. Next question, UAM is actively buying in shares. How do we balance that with our capital allocation? I think to note, the buybacks I see as an opportunity to buy our shares cheaply. And if we like the portfolio, which you can hear we do, then buying them in at a 17% seems to me sensible. I think we want to provide a degree of day-to-day liquidity in the market as well. And so that will probably continue until discounts narrow. Historically, under 10%, we have usually not bought back in the market. But at the moment, with where the discounts are, we're perfectly comfortable buying in a modest amount daily. Next question, what measures do we take to hedge against currency risk, particularly volatile markets? We constantly look at it. We constantly look for instruments that could help us hedge the currency. But every time you look at them closely, they're just too expensive. And so currency is a risk within the portfolio. I'm expectant that over time it'll be a headwind, and then a tailwind, then a headwind, then a tailwind, and hopefully it balances out over the longer term. So we don't hedge mainly because of the cost involved, but we do hope that it balances out. So the next one is, how does the 17% discount compare to the discount average? When we floated, this is back 2005, we were a marginal premium. We actually issued further shares into the market. But it's fair to say from 2015 to almost up to the COVID pandemic, the discount was under 10%, so 6, 7, 8%. Post-COVID, I think discounts across the sector have widened out, and we have been caught up in that widening discount by the market. And so I would say since COVID, discounts have been 12 to 17%. I would note that I think, like most markets, investors are looking to invest in fixed income, and certainly equities are out of favor. And we see that from the retail investor in Brazil, from the retail investor in Vietnam, China. And one of the attractions, I think, is, as Jax noted, once interest rates fall, there should be a sort of renewed interest from underlying retail and institutional investors into their local markets. And that will be the substantial driver. And I think the same will play out in the UK stock market, where if you want. Investors at the moment are investing in fixed income, etc., and they are marginal sellers of equity, including Utilico Emerging Market.
Charles, Jacqueline, Mark, if I may just jump back in there, and thank you very much indeed for addressing all of those questions that came in from investors. And of course, if there are any further questions that do come through, we'll make these available to you immediately after the presentation has ended, just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the platform. But Charles, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Thank you. I think my closing comments are, we have a high conviction in the underlying portfolio. The management teams and the investments are delivering significant gains. They're undervalued, as I've said. All these markets are trading at low multiples, and you can buy our portfolio at a discount. I think it's a compelling story, and I hope that you become investors. Thank you. Thank you from all of us.
Charles, that's great. And thank you once again for updating investors this morning. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of Utilico Emerging Markets Trust PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.
Thank you.
Thank you.